Okay, so this is a little video to show you how to do your homework. I'm going to be giving you an Excel template each time to do your homework on. And the first thing to notice that here at the bottom is that you have different tabs. So in this instance there's 4 tabs for the 4 assignments, and so sometimes it'll be 4, sometimes it'll be some other number, but just know that there's multiple tabs you need to look at. And they'll be set up here so that you basically just have to fill in the numbers. You don't have to know a lot about Excel. You're just going to basically, in some cases, put an X for something or put a number depending on what it's asking for. So going through your homework, this first one, for example, is set up for CP 2-1, which starts on page 60 and 61. And basically on this one you're just going to put an X, which accounts are debited and credited. So the way this one's set up is not any specific accounts like cash account or equipment account. It's just an asset account. And notice that asset is spelled there incorrectly. It should be just asset. And this is set up so to give you an idea that on the double entry accounting, which is the debits and credits, basically every asset, all liabilities, all revenue, and all expenses are treated the same way, meaning debits and credits affect them the same way. For all accounts, debits are always on the left, credits are always on the right. So you're always going to see that set up, debits on the left, credits on the right. But how those impact each individual account is different depending on the type of account. So for assets, for example, debits always increase that account, credits always decrease that account. Just the opposite for liabilities. Debits always decrease, credits increase, and you can see them for the rest of them. So that's a little counterintuitive because sometimes debits increase, sometimes they decrease, depending on the type of account. But what is consistent is that all assets are treated the same, all liabilities are treated the same, capital is the same, revenue and expenses are the same. You just have to sort of get in your mind whether debits or credits increase or decrease that type of account. So for this first one, for example, if you look at your text, it'll say for number 1, and this is the transaction numbers over here. Number 1, the issued share capital for cash. So what's being increased? So your cash account's being increased. Cash is an asset account. If you read the text, it'll tell you that. So put an X there for cash increases, and they're buying share capital, so share capital's increase. You look over here, credits increase. Now you should always have debits and credits for every transaction. There's never any transaction that's only debits or only credits. There's always going to be offsetting. The numbers always have to agree. There always has to be balance. So if there's a $1,000 debit, there has to be a $1,000 credit somewhere. It always has to balance. See, number 2, they paid cash for a truck. So this is an instance, kind of an interesting one. We have both an asset that's increased, which is the truck. It's equipment that's being increased. But also you have an asset that's being decreased, which is cash. So they're different assets. One's being increased, one's being decreased. Nonetheless, that's how it's handled. So each one of these, but you still see we have an equal debit and a credit. So that's just an example of those first 2. I'll let you do the rest of them. If you have any questions, let me know. For CP2, it's a little bit different. Rather than X's, we're going to use, CP3, we're going to use numbers. So if you look at your transaction, this just says the transaction number here, but there's detail in your text. Number 1 is purchased a $10,000 truck on credit. Whenever you hear on credit, that means they didn't pay for it yet. They owe the money on it, so that creates a liability. So again, that's an equipment, which is the type of an asset. So that's $10,000 there. And an increase of liability because it's on credit. Now notice here we didn't have all of the accounts, income and expenses. We're just going to do partial entries on this one. Number 2, we borrowed 5,000 cash from the bank. So here again we have cash increase, which is an asset, and have another liability of $5,000. So just like that. And again, here you can physically see debits equal credits, debits equal credits. They all have to equal. So whatever you do down here for the rest of these transactions, make sure debits equal credits. CP2-4. We're going to put, again, debits and credits here, but instead of debits or credits, we're going to put account titles in here. And don't get too concerned about the exact account title. If it's something that close enough that I know what you're talking about, that's good enough. So whether you call it equipment or truck or whatever, I don't really care, as long as you know that, and I know that it's an asset type of account. So don't get hung up on what you should call it. Just call it something that's descriptive. So number one, the issued share capital for cash. So we don't know the amounts. We're just putting titles here. So again, we got cash and share capital as the debits and credits. Cash is increasing, which is a debit. Share capital is increasing, which is a credit. If you go back to this thing here, you can see your debits and credits if you want to refer back to that. Transaction number two, equipment was purchased on credit. So equipment, and then some kind of payable over here, accounts payable, or you can just say payable at this point. We'll get more specific as we go, but as long as you get the idea of what kind of thing it is, then we're good with that. And that's number four, and you can do the rest of those this way. Again, we're not doing amounts here, just the account titles. And then we get to number five, and we're going to put these in what are called T accounts. And in the book, it says, you know, put a little number by them as the number of transactions. You really don't have to do that. You can look at the example they gave you in the book. I'm more concerned just about the amounts right now. So again, debits and credits, you can refer back to this if you want to see the debits and credits, whether they increase or decrease. Debits are always on the left, credits are always on the right. So first transaction is issued share capital for $5,000. So cash is going to be increased, which is a debit. Share capital, which is going to be increased, is a credit. Transaction number two, paid in advance $900 for 3 months rent. So we have something called prepaid rent. So when you pay rent in advance, it's an asset until it's used up. It says that in the book. $900 rent prepaid, because prepaid rent is an asset. It's increased, so it's a debit. And then it says paid 3 months rent. So we assume since it's been paid, you don't owe it anymore. So you're going to have $900 reduction in cash. You wrote a check basically for the rent. If it had said paid $900 for 3 months rent on account, then we would have gone to an accounts payable kind of an account. So that's a couple transactions there. I'll let you do the rest of them. There's a total of 11 there. You'll see those in the book. And if you have any questions, let me know.